think we're live, ladies and gents. Welcome. A few minutes late, so just got to clearing out the inbox. It's never clear, is it? It's never clear. Just put it on Do Not Disturb mode, and the most ridiculous email landed on my inbox. The most ridiculous, ludicrous claim. These guys are getting crazy with their claims of risk rewards, win rates. It does make me chuckle. Anyway, we'll get started in a few moments. What's been going on with the market? Welcome. By the way, welcome. What are we going? Nasdaq's down a smidge. It was down a lot more earlier. It's kind of sitting by the VWAP now. Gold's on a tear. What else have we got going on the old books? Nvidia took an absolute dive at the open. Managed to recover a reasonable amount, but that was an interesting move. You guys watching Nvidia out there. Dollar still under a little bit of pressure, right? What else cooking? What else is cooking? To be honest, all eyes were on the Nasdaq today, right? Wasn't that? So it's a real swing thing. It's not very often we get a real heavy sell-off off the open, but if I may, I will tell you this. So yesterday we had, I know some of you guys don't trade Nasdaq, but this is interesting, right? Yesterday we had a huge drive off the open, huge opening drive, kind of a bit of a pullback drive again. By the way, if you went to the last webinar we did this, yeah, the open setups, we've had a lot of those both ways last week, immediately after the webinar, and obviously a couple, one today, one yesterday. So if you look at we had the similar type of pattern. Now where was it? Here we go. So yeah, Wednesday the 9th, right? We drove straight up hard. The next day we sold off hard. And what's happened today? Monday we ripped up hard, and what's happened today? We sold off hard. So I mean, they're playing with us. Those algos. I mean, anyway, you've got to be careful. Listen, I think that the sort of takeaway is, regardless of what you trade, is be careful of recency bias. There's so many people. I remember last time it happened. I'm going to buy. I'm not going to miss this. I'm not going to miss this rally off the open this time. No way is going to catch me out, and it just falls through the floor. We've had exactly the same 2-day pattern, Monday, Tuesday, as we had on the 9th or whenever it was. I said so. Just be aware of this type of stuff. We'll get started. I think, well, we may as well look at time. It's 1 minute to go. What else I've got to say to you? Let me mention this. So we'll get started now. This is great book by, you can see that one? Yes, you can. Bulletproof Trader. Is it reversed on the camera? Maybe it is. It says Bulletproof Trader by Steve Ward. Favorite, actually, I had it on the podcast a couple of times. I want to read you a little excerpt, if I may. Have I lost it? No, there we go. Let's not sit here and read the whole damn thing. Okay, research into the impact of results-focused decision-making has found several downsides to becoming too outcome-focused. So, some backdrop here is if you're focused solely on the P&L, right? So if you're glued to that P&L, whether it's the end of the day, whether it's during the trading day, this is what Steve Ward says about this. Performance anxiety increases, cognitive capability reduces, loss aversion increases, a tendency to focus on outcomes with higher certainty arises, ambiguity aversion, overcollection and use of data, both useful and useless, increases. And he says a continued over-obsessive outcome focus can also reduce innovation, learning, and risk-taking, none of which is desirable. And it goes on, blah, 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 skips, what's the solution? The answer is to develop a stronger process focus, to become more aware not just of the result, but how you got the result. And when executing your trades, you spend less time focusing on whether you're making money or not, and more time focusing on the task that is most important in that moment, taking the actions that are required to maximize your chances of success. Thank you, Mr. Ward. Yeah, I mean, that makes so much sense, right? We talk loads of times about not having the P&L on the screen, not being too focused on the P&L, but we're traders. That's the scorecard. And so it's very difficult sometimes to not think of that. There are all sorts of tricks and tips and ways of doing this. One is just remove P&L from the screen. I think that should be a given. And the loss aversion thing, I think, is probably the one that most people suffer from, is that if you're taking a trade, especially if you're an active trader, You're looking at the P&L, you're scared of seeing that money coming back. You see the unrealized P&L, you're up decent, you're frightened of giving that back, even when it's just the market maturing, it's the trade maturing, it's the natural rotations and ebb and flows of the market. So something to consider there. I know we talk about all the time process focused, but even intraday, even doing things just to make sure that you aren't thinking about the money. Showing you guys the poker chips that I have on my trading desk that I use as a kind of R unit to work out in my mind. Hey, I think in terms of R units, not in terms of P&L. That makes it easier to scale up the operation when you're ready to do so. Okay, thank you, Steve. Let's get on with today's topic, the topic du jour. I like this one. I've been looking forward to this one. Solving the confirmation conundrum. How to spot enough evidence to act without being late. A great little quote here from Winston Churchill. Although he was, people believe that he said this. Not sure if he did or not. Unfortunately, I can't ask him. But he said, perfection is the enemy of progress. And fun fact, I used to have a cat called Winston Churchill. He sadly died a few years ago. He was pretty much like him as well. He was a bit of a chunky guy. Not from overfeeding, though. He's just a chunky boy. Right. Let's just get the disclaimer out of the way and I'll introduce myself and we'll get rolling and kind of share what we're going to talk about today. So thank you for being here. First of all, I appreciate there's lots going on. The market is, well, it's calmed down a little bit than it was this morning, but I appreciate you. Any other place you could be attracted to these really good thumbnails on YouTube telling you all these amazing win rates you can get and stuff. But you're here. Hopefully, I'm going to make it worth your while. In fact, no, I am going to make it worth your while. First of all, let me just remind you, ladies and gents, that, of course, if you're trading leverage instrument like a CFD, like a spread bet, there is a very high chance that you can lose money very, very quickly. So please be aware of that. Double-edged sword, we talk about this all the time. Leverage is great when it's working in your favor, but risk happens fast. Just ask the people who bought the NASDAQ at the open today with a full boat and then just sat there and watched it deer in headlights. And amplifies, as Steve talks about this type of stuff as well. If you're constantly glued to the P&L, you get that deer in headlights syndrome, which is even worse when you're using leverage and it's going against you. So just be aware, right? Just be aware. You're an adult. You can make your own commercial decision whether you want to trade or not. And you're here. I guess you do. But please understand the risk. If you stumbled across this video somewhere and you haven't got a clue what we're talking about, then go elsewhere, because this isn't something to dabble at. If you do it properly, the results can be great. If you mess around with it, the market takes no prisoners. So let's move on from that. And just a quick reminder, I don't sit here and claim to know everything. I started trading in 2001, traded through massive amounts of different environments, different styles, different market conditions, reading tape aggressively for years, then scaling back and going higher time frame stuff, then doing this and doing that, just evolving with the market conditions. And I don't stand here and say, hey, what, despite the market being kind to me over the years, that I know everything. Absolutely not. And that's what I love about this journey, right? Even 24 years in, 25 years in, whatever it is, we learn something about ourselves and we evolve as traders too. We evolve as people, we evolve as traders, the markets evolve, and that ever-changing dynamic nature of us and the market is just that perfect puzzle. So I don't stand here and say I claim to have all the answers, but I'll share with you ideas and thoughts that I think are valuable from my perception of things, and the fact that I also have interaction with many other traders, dozens of other traders from different kind of different personalities, let's say, different approaches, different styles, time frames, etc. And I kind of see what works for them and what doesn't. So I bring that all together with these webinars and try and present to you what I think is, hey, I see this as a common mistake. I see these people and I've done this and this has helped and blah, blah. So I try and filter through the stuff that I think is going to be most valuable to you. And as always, please do your own research, analysis, homework, and don't take anything I say as gospel. The idea is that you plant that seed, a little spark in your mind that you go off and go, you know what, that's interesting. Let me dig into that a little bit further. Okay, so let's start the ball rolling. I want you to picture this. If you're an active trader, you've probably been in this scenario many times before, right? Price comes down, it hits your key level. You've been waiting for this trade. Now you say, well, I want to see some confirmation. I just want to see something to prove that I'm right on this trade. I don't want to dive in too early. I don't get caught out. It's in free fall. It's on my level. But let me just wait for some confirmation. And so you wait. Now, price rips up off that level. Imagine the long side rips off the level. You go, it's a lovely confirmation candle. I'm going to buy. You get it. You feel all pleased with yourself. All of a sudden, it reverses, comes down and stops you out, or rotates back, and you're second guessing because you're watching P&L, thinking, damn it, what do I do with this? It's not really what I wanted. I thought it was great. And that's the danger with confirmation, right? And so today, I want to kind of suggest a different way of looking at confirmation. And I'm not here to say there's not a place for waiting for traditional confirmation, if you like. And I'm not here to say that we should just stand in front of freight trains and just be blasé. There's a sweet spot. So I'm going to suggest different ways that maybe help you execute your trades with a little bit more precision, for want of a better word. It's not the best word, but because you can never pinpoint stuff, right? Anyone tells you they can pinpoint stuff perfectly all the time isn't telling you the truth. Sometimes you're going to get a great read on tape. It's going to flip nicely on you. Sometimes you're going to do things absolutely perfectly. But at times when you misread it, that's why risk management is so key, of course. But let's unpack why this type of thing happens quite often. So there's a mixture here, right, of operations and mindset, if you like. So operations being the dynamic nature of the market, the ebbs and flows, the price action, the tape, just the normal rhythm and structure and regime of the market conditions we're in. And then you've got your mindset, which is often plagued by fear, plagued by uncertainty, doubt. What's the acronym FUD? Just said it. Fear, uncertainty, doubt. You're just plagued by that. And even you've had a good run, a bad run, that as well as ebbs and flows and ups and downs. And the way you think about trades, the way you perceive trades, the way you perceive price is often clouded depending on your recent performance, whether that's the day, recent performance in the week, stagnation. All this stuff can impede and influence how you perceive price, right? So often we default to the easy trade, if you like. And the easy trade is, well, if I wait for confirmation, that de-risks things. Just like Steve was saying here in Bulletproof Trader, loss aversion is very, very real. And often we make commercial decisions about our trading that actually we think we're de-risking it. We think we're reducing the risk. In actual fact, we're flipping that on its head and we're actually taking on more risk. And this is the kind of dichotomy of trading in a way is if you wait too long for something to become absolutely, convinced that it's going up is often the time when it rolls over. Here's a funny thing that you probably see, and you probably know yourself, right? You see people on social media who declare they're in a trade. I've been long this forever. This feels great. When they feel peak emotion, peak certainty, they post their position. And that's very often the time when it rolls over. You may have done this yourself. You may have told someone about a trade you're in. Maybe you post on social media as well. And you've gone, oh man, I've been in this trade for doing brilliantly. And it's because you're feeling so good about it and you feel like this is the peak moment, you share it. And of course, that's the emotion that often the crowd feels, which is often why the market rolls over. I'm going off piste a little bit, but you get the idea. Okay, so if you think about it from an operational perspective, you see the trade, you saw the trade, you wanted confirmation to de-risk it in your brain. Like, oh, if I get confirmation, that'll de-risk it. Okay, great. I want to get my ducks in a row. This. That de-risks it. That's a great way of playing. And so you waited like a good boy or girl. So you're like, okay, I'm going to be a good boy. I'm going to wait for my trade to come along. And by the time the confirmation came, it's too late. You've taken a trade and you've ruined the structure of the trade. And I've got a great example for you from today on gold. Real example, right in the thick of the stuff, right in the trenches, front line. This is perfect example for you today. Okay, before we look at the examples, let's just think about what the textbook calls confirmation. And by the way, I'm a big fan of, there are certain things I think the textbook says which should be taken as gospel, right? Taken as gospel, but should be adhered to. Risk management, of course. Everyone says risk management is important. Of course it is. Otherwise, your equity curve is just going to be crazy, and it only takes one landmine to step on, and it's game over. So, there are certain north stars and headings that you should probably do as a trader, which I try to adhere to as well. It's like, okay, well, risk management is very, very important. I want to try to squeeze as much from my trades as I can. I want to make sure that my emotion, all these kind of default settings should be there. But when it comes to technicals, I find that the textbooks, not saying that they're wrong, but sometimes they can be so outdated, right? The market I was trading 15 years ago is not the market we're trading now. The environment is completely different. The algorithms are way more sophisticated, and the market the guys were trading in the 60s, the 70s, and even earlier is completely different. You talk about these turtle traders who are buying 30-day breakouts and making a killing. 30-day breakout now, you're way too late because there's so much more rotation and there's so much more quantitative funds in the market and different participants and different what's the word I'm looking for? Different derivatives or synthetic instruments, that type of stuff that cause the market to trade in different environments. So some of the textbook type of stuff is okay, but just be mindful that very often it doesn't serve you in the current conditions. So I always look through this lens and go, okay, what's the crowd doing? If the crowd's doing something, I probably want to think of a better way to do it, or even better, leverage on the crowd coming into my trade and giving me that final shove that helped me some exit liquidity. And so I appreciate it may not be trading direct access, but as in the final pop. So I'm often trying to reverse engineer what something could look like on the chart. I'll explain in a moment. And how do I front run that rather than waiting for the confirmation that everyone wants and goes, yeah, I'm long on this and is it great? And because that's really the time when you quite often want to take some of the chips off the table. Okay, so confirmation, most people say, hey, I want to see the candle close. I want to see the hourly candle close at the high side or low side, whichever you're looking for. Maybe you want to see a break of a level. Maybe you're looking at an indicator, moving average crossover, or some sort of pattern that proves the idea. And again, I'm not saying this isn't correct in some circumstances. In a lot of circumstances, you may want to say, hey, I need to see a candle closing. I need to see this, but it's a very particular type of trade, I believe. And that type of trade is one where you're going to have to probably take some heat on the trade. You might have to sit through some rotations, but you've got a really high conviction of a higher time frame target, and you're kind of looking at it through that lens, right? So we're not saying this confirmation is completely thrown out the window, but I think we can do better. I think you and I can both do better in the way that we look and the way that we think about confirmation and saying, okay, the trade is ready to go, because we can't de-risk a trade, and we don't want to try to de-risk it, because as soon as we think it's de-risked, like I said earlier, I think that's when it's the highest risk. And so the catch with doing that is, by the time you get the confirmation, the move is mostly done. Like if you're waiting for confirmation, you think about how you frame this in your mind. For long confirmation, you want to see the market go higher, right? This is what the textbooks say. And for short confirmation, you want to see the market go lower. So you're already getting a move in your favor. And the textbooks would also say that the bigger the move, the larger the excursion away from, say, a key level, the bigger the confirmation and the more conviction you have. I don't think that's correct. I think that very often in the current market we're in now, 2025, and the regime we're at now, very often that signals either exhaustion or more likely an overdue rotation. So if you're in a bull market, very often, that's not going to be the high, you're going to get continuation. But you and I both know how the market rotates, whatever market you're trading dollar, you're trading gold, you're trading the indices, European indices, US indices, whatever it might be. Very often we get a new high, we get a breakout, it rotates lower. It does a bit of consolidation, bit of backfilling, goes another leg. And so, you have to structure the trade differently if you're waiting for that and you're buying kind of after the move is already done. Not to say it can't be valid, but I think if you're trying to really optimize your risk reward and kind of really get the high risk reward ratio trades and really try and get your numbers up, which is what you want to do as a trader, right? We want the risk reward to be as high as possible. And we're not talking silly numbers. We just want to try to get it, 2 to 1, 3 to 1, 5 to 1, the occasional 10 to 1 and more, the occasional runner you might get, but you want to be on that side, right? You want to be 2 to 1, 1.5 to 1, fine, just about, depending on how you trade. It's very, very, personal and depending on how you operate. And you want your win rate to be high. Because even though theoretically you can make money by having a 10% win rate and a public mass, let's say 50 to 1 risk reward, that would be fine. Most people can't stomach loser, winner. I've made all my money. That, from a psychological perspective, that's very difficult to stomach. And I think it's the same with the 90%. You have a 95% win rate, maybe, but the one time you lose, I don't know, 50R or something, it's going to sting. So you want to find the sweet spot, and you want to have, a decent win rate and a decent RVR. And that's the kind of throttle and adjustments you should be making. I think it's dynamic as well, depending on the conditions. Sometimes you are just looking for A to B, high probability, 1 to 2, risking one to make two. I say risk reward risk, really, you know what I mean. You should be operating those two levers, right? So, and also, I think, we want to get the most R that we can from the trade. So we want to be as early as we can in the trade without standing in front of a freight train, for want of a better word. Great example today, if you were trading the NASDAQ, if you jumped in too early and said, I don't need to wait for some signal, you just don't. Where's the bottom? You could see, you're kind of stabbing at it. So you need to see something, right? We need to see something the market's going to turn. And if we're too late, we're just part of the crowd. And like I said earlier, I think the way that I like to think about positioning is, I want to be as early as I possibly can without being reckless, so that I can be already in the position with a profit cushion when the crowd is ready to get in, because that gives me an opportunity to either peel some off if I want to, add if I'm feeling aggressive about higher time frame target, or hold and sit through fake outs, rotations, wobbles, because it doesn't matter too much because I've got such a chunky unrealized P&L. And I think that's really good for the mindset as well, rather than waiting, chasing, sitting back. I think that trading is very much about, obviously operationally you want to optimize the performance, with the RVR and the win rate, great. But at the same time, there's a third hidden lever, if you like, and that is, how does it make us feel? Because we're human beings, right? And on paper, you might be like, well, statistically on paper that looks like a very good, but in the real world, can you sit through doing nothing for days on end? Can you sit through losing streaks that go on forever? Can you sit through knowing that actually you could have a real heavy down day out of nowhere? No, you probably can't. So you've got to adjust the trade you take and your overall playbook to align with you as a person, as well as operationally to align with the dynamic conditions of the market. Okay, so the late entry trap. So example here on what have we got here? We've got the it's the Nasdaq. Of course, it's the Nasdaq. So very often you see this type of stuff, right? Very, very strong. Oh, great! I'll wait for the candle to close. It's going to break out. You go long, and by the time you've gone long, this was yesterday's drive, by the way. By the time you've gone long, it's rolled back on you. You've held it, and let's say you're swing trading this on a 1 hour chart. It's rolled back, and you're like, oh, it's 50% stop. I'm out. Or you're sitting with a load of heat. And so very often we see this where we think it's a safe trade to enter after the confirmation, but it really doesn't serve us. And like I said, the textbook, listen, I've got some great books on my bookshelf here, another shelf over there and downstairs, but there's time and a place for just understanding what the market's telling you. And the market very often tells you something different to what the textbooks do. And your job as a trader is to read what's happening and adjust and adapt. Obviously keeping risk as a red line, but being smart about how you enter the trade. So I think we crave confirmation because of this. We need certainty. And like I said earlier, I think that we go, well, I won't take this until I have all my ducks in a row, and I have this, and I have this, and I have this, and I have this, and the textbook says I want to see this and this, and then I want to see the confirmation, I'll take the trade. And I'll structure it like this, and I'll put my stop here, and that's very good. And you get a golden star for doing it by the book. You say, well, I've done this, and I've structured my trade here, and here's my target, and there's this, and they may work. They are going to work from time to time. I'm not saying they don't. But if you want better performance, I think you can be more aggressive. I think you can reframe how you think about confirmation. So need for certainty, fear of being wrong, like Steve Ward was saying, with the loss aversion, and you need to see it before you kind of believe it. And as I mentioned here, in trading, waiting, the longer you wait, the more the risk expands, especially as your trade's moving in your direction. You're like, Mark, what do you mean? But think about where that rotation level is. I'll try example in a moment for you. If you're still working your stop off that low, which you probably should do, is like that's a line in the sand, the further away it gets from that low, the wider the stop's going to have to be, and the wider the target's going to have a decent RVR on the trade. Or you keep the target the same, and all of a sudden the RVR is shrinking and shrinking and shrinking and shrinking. And so actually you're increasing the risk on the trade. The further it goes in your favor, you're increasing the risk on the trade. Not every trade. I'm generalizing, and I know there's great examples of trades that you want to wait and you want to see it clear and not do this. Fine, but very often, especially with an active trade, reacting too late doesn't give you a very good reward. So I think that the best traders look at price intent, not textbook signals. Look at context, the market regime you're in. We always talk about that because that's so important, regardless whether you're an active scalper, whether you're working bids off kind of flushes, whether you're a momentum trader, whether you're a trend trader, mean reversion trader, 4 or 5 day trader, whatever. The context matters so much. What's the engine of the market at the moment? What's it responding to? What's the story? What's the trend? What's the rhythm? What's the feel? At the moment, right now, regardless of whether we're down today or not, we're in a bull market. We're responding well to negative news, generally speaking. It could change in an instant. Of course it could. But the regime is, hey, tariffs are having a limited impact now on the market. We've got the 1st of August thing coming up. Everyone's looking at earnings. Is that affecting the dollar, affecting gold? You know what the driver is and you know what the sentiment type of thing is. So we want to look for subtle clues like wicks, pauses, failed moves, reclaiming levels, example in a moment. And we want to plan, right? We want to plan, not reacting into stuff. So let's redefine confirmation. Let's rethink how we define that from a trading perspective, right? Everyone's talking about confirmation. Let's just bear with me for a moment and come this roller coaster with me, and let's get rid of that and let's try and define it in a different way. Because it's not about being sure. It's about, as I say, it's about seeing just enough to take the risk decision with your stop. So it's like saying, okay, fine, I'm managing the risk still. We're not getting to a point where we're blasé about risk control. Of course not. I'd never ever say that. We must control our risk above all else, right? Especially with trading, we leverage, all that type of stuff. We know that it can get nasty very quickly. So we're not being silly, but we're saying, hang on a second, I don't need to wait till the crowd has told me that we're going up to get in. I need to be smart here and wait for the first clues that we're rotating off a low, that we're breaking out, pulling back, whatever the trade might be, and anticipating, the slightly lower time frame, or a tighter time frame if you're on a. What I mean by that is kind of not necessarily going down to a lower time frame chart. If you trade off a 15-minute, you down a 15-minute, but you're not waiting for a full 15 minutes worth of price movement before you make a decision. You're waiting for maybe 5, you're waiting for 3, you're waiting for 7, as opposed to 15. Now, you may well choose to go down to a lower time frame to kind of get into the groove of that, but it's not about over trading. It's not about changing the way you operate. It's about just being a little bit earlier on the trade so that you can be in a position of power, right? And so that when you're in a trade, the goal is you want to work yourself into a position so that you're there in the position with a cushion ready when traditional confirmation, if you like, turns up, and then you can choose, like, is it trapping people here? Is it good confirmation that means I've got a good cushion, I can hold it? How do I want to operate this? So here's a great example today from gold, and you can see when I kind of did these slides. Hopefully you can see that. So the time on that is was about the open, just before the open. I remember this. So got gold context, high time frame context, daily chart, been in a range for a while, long, big kind of big range at the top of the drive, near all-time highs. We've had an explosive up move yesterday, as you can see, with high volume and decent range. So today, your thesis could be, and again, this is where context is so important, right? Your thesis may well be, hey, if we find some support the next day 2, which is day 2 today, I'm going to get long, right? I'm going to get long. And maybe, you go, oh, well, if we break the highs, I want to get long. That'll be traditional confirmation. So this is kind of the pattern we had. And your textbook trader would say, well, actually, we're going to go long when we break the highs. The high there was on the futures contract was 3, 4, 16, 8. The CFD slightly different. What is a CFD trade? It's a synthetic based on the futures, and the rolled up, and it's kind of mapped up. Whatever you trade, the CFD, the spread bet, whatever it might be, the high is the high, right? The pattern's the same, chart's the same. So as price breaks through, traditional trader would say, well, I want to buy that and get long. There's nothing wrong with that. I think that's valid, especially when you look at the higher time frame context. You look at the prior day, you look at what's driving it. As we go back, that's the most important thing. The context is important, but we can be smarter. And so traditional textbook trader says buy when we go through the highs. Confirmation. You see a confirmation. Okay. Now, redefining confirmation, we're in a 15-minute chart here. Okay, now, if you were saying, well, I'm going to wait for confirmation, I want to see strength, I want to buy it as we break the high 314, 416.8, whatever the high print was, That's fine. However, if you are reverse engineering that and you're being a little bit smarter than everyone else, and you say to yourself, hang on a second, right? That is feasible. We could easily break that high and we could easily rally through that, and we could easily put on another big strong day. Everything's lined up with the context. I feel like it's a good trade. I want to be in the position before we break the high. I don't want to wait for traditional confirmation. I want to get in earlier, and so I'm in a position of power where I have a cushion and I can sit through whatever it wants to do and mess about and do this and do that without being the sucker who's bought right at the high print and had to sit through rotation. It could be a fake out, it could be rotation before we move higher. Spoiler alert, it was, but so something like this, right, where you go one step back and you say to yourself, hang on a second, if that were to be the case, if we were to print this bar that breaks through on the daily through that prior high, okay, what would I need to see? Well, we're probably going to do some sort of bottoming, and I'd like to see a level hold, and then there's multiple other things you can see. But on this example, which was today, and I screenshotted it right as it happened, you start to see price building. Yeah, support starts to hold, and then we start to see decent range bars, decent volume bars starting to creep back up. And so now, if you're a gold trader, you've got this thesis. This is the sort of thing that you can then look at and go, hang on a second, this might be my new definition of confirmation. So you're not buying like as it falls lower and you're buying, oh, it's down, I'm going to buy, and sitting there and sitting there and sitting there. You're saying, hang on a second, I'm bullish. I have a thesis. So the confirmation for me is a support level. Now I want to see someone starting to buyers starting to step up, lift offers, hold bids, sorry, take offers, and keep pushing this higher. And so you start to see the turn. That then becomes your confirmation, and we're on a tighter time frame here, but it's molding into you're folding into a larger trade, which is going to give you so much better risk reward on the trade and so much better structure. And actually, I honestly think it's better for the probability of success of the trade as well. We're not diving in recklessly here. We're waiting for a different type of confirmation. And you can look here, if we go down to a 5-minute, how the character, there was a character shift in price, right? We had the support there. We started to see volume coming in on the 5-minute. We started to see an expanding range. The ATR starts to increase. That indicates buying. It was a bit more aggressive buying. They're hitting offers, they're holding. This is all indicative of a good run. Now, the traditional trader says, well, I want to buy the break. But I think the smart trader, again, this is my opinion on stuff, is front running that. And this is just an example. We're using a breakout example because it's actually happening today. But the trader is saying, hang on a second, if I can be in the position, I'm in a real good position of power, rather than buying it at 3, 4, 17 as it breaks through and saying that's confirmation, that's textbook stuff, that's great. You now put yourself in a position of control, right? If you bought it, say, even if you're a little bit late and you're buying it there at 3,400 and your stop was below the low, which I think is probably correct. If the support's holding, a thesis is probably going to be, hey, you know what? If that support breaks, I want to be out, and that's perfectly acceptable and perfectly fine. I think you now have a trade that's 3-to-1 risk reward, or reward to risk, having a frame it. So you're making 3, risking 1 just at the high. So you now put yourself in a position where, rather than everyone else who's waiting for that confirmation, your confirmation is a tighter time frame. You've jumped in the trade. You've structured what I think is a clean trade. I mean, I don't think anyone can argue that's not a clean, structured trade. And you've got the context, you've got everything lining up. Now you're 3-to-1 as it comes through the high. What a beautiful position to be in. What a beautiful position to be in. Because now you can say, do I want to cash flow the trade at 3-to-1 and say, you know what, I think it could fall back, I could rock back a little bit here, let me peel some off, let me cash flow the trade a little bit. I'm in a nice position then. So psychologically, it relieves some of the pressure, it relieves some of the burden, because you're a little bit smarter about going a little bit earlier, and confirmation meant something different to you, as opposed to the guy who's buying now. And there's nothing wrong with that. However, the structure of the trade changes completely. This is okay. We went crazy today, but if you bought this here now and you had the same 3-to-1, and I'm kind of being kind to someone here and saying, well, maybe if you had to stop 50% of that kind of big drive from the lows, rather than, you could argue actually the stop should be in the same place as the other trade. But let's give someone the benefit of the doubt and say 50% momentum bar closing at highs. There's my confirmation. To get the same 3-to-1, you need to have that target way up there. Now, believe it or not, today it did hit it, and that's a great example, because actually, when you look at today's action, I should have put a slide on. But on gold, we went up to where were we? We went up to 3,433, came all the way back down to 3,415 before going back up again. And so the point is, it's not that it makes it a bad trade. The point is, if you're earlier rather than later on the trade, you can sit through that. You're like, I don't care. Like, I've already cash flowed the trade 3-to-1. Thank you very much. I'm already now in the position where everybody else is coming in. The whole crowd's now coming in. They're all spooked out. They've been shaken out by the drive and shuffle that we had when the Nasdaq sold off. It's now pushed back up to highs. It's very difficult to sit through that with a full size clip when you are when you're buying so late in the move. And so, so thinking about, if you're using the same risk reward, it's so much better. And, if you had that 44, I mean, I didn't want to put it on, but it makes it so much better in terms of risk reward ratio stuff. I mean, if you had the same target there, whatever it was, 46, and what was the stop loss going to be like? Say it's $10. It's like, well, it wasn't even $10, it's like $8. It was changing the dynamic of it completely. So something to consider is, I don't think there's anything wrong with taking trades that have the confirmation, but if you want to really maximize the risk reward ratio on the trades, if you want to kick things up a gear, the answer may well not be, oh, well, I'll just do more size, I'll just do this. It might be just being smarter and going down the time frame a little bit and redefining what you call confirmation, so that you can be in a position where you're already in the trade. And if you get stopped out, you get stopped out. Fine, you're going to get stopped out. But I would personally rather be stopped out on this. Let's go up one more. I would rather be, where's my 5? I'd rather be stopped out. If I was buying on this and I start to see it building, and I'm buying at, say, 3,400, I'd rather be stopped out down here at 95, 94, $6 and go, fine, that's my risk allocation. Say you've got a couple of $1,000 risk on the trade, or $200 risk, or whatever it is, and say, okay, well, actually, if this starts to build, I still think we're going to break out from the high. It just puts you in such a more position of power. You're not second guessing it. Your confirmations change from being, well, I'm waiting for the bar to close, versus actually my confirmation is a character shift, a change in tape, a rise in volume, a hold of support, and you've gone one layer back than everyone else in the crowd who's waiting for the stuff. Because very often, don't forget, most people aren't monitoring markets. They are, oh, that's broken the high, let me buy. Oh, that's broken the low. They are reacting, as opposed to being prepared and being positioned for a break, ready to go. I mean, if you bought that 34, you're up $44 today on the trade. And again, I did this kind of in real time. I didn't know what we were going to do, but the point is that it's a very, very different approach as an active trader. So key signs of intent, and this is a good way of framing it, is an intention. And back there, that example on gold, we saw that you just pick up in volume, a pick up in pace, a just change in rhythm, right? And if you watch markets for any period of time, you know that when they see that change in rhythm, something's different. And so when you fold that into the higher time frame, you don't need that kind of full confirmation. So reclaim of a failed break, maybe some absorption or some support holding, price pauses, drives, weak hands flushed, as it going to flush through the low and then a Wyckoff spring. Very often that could be your confirmation. Hey, I see it flush through the low. A flag is a kind of classic one, right? You get the pole, you get the flag. People want to see and buy a break of the high, but why not wait for the break below the low and come back up and say, well, that's my confirmation. A little Wyckoff spring, a little test, a little dip below. Sellers don't want to get involved. That's what I need for confirmation. And then now you're positioned, fine. You can still put your stop where it would be, but now as it comes to the high at the top of that flag, you're in a position of power. Do you cash flow the trade and take some de-risk it, or do you sit there and go, you know what, if he wants to break fake out for a bit and mess around, that's cool with me because I've got plenty of cushion, versus the trader who's buying the break of the flag and he's there now as it comes back into the flag, and I've got to, you put yourself in a kind of position of weakness. Okay, so some things I think probably should be avoided is buying a break of a level. Now, again, I'm not here to. I'm generalizing rather than saying that everything should be like this. There are times when you've got a pure momentum trade, and fine, you may want to buy a breakout, and that's okay. There's a playbook for that, and that's absolutely correct. But what I really mean is if it's led into, oh, well, I'm going to buy very late in the move. If you're really late in the move, then just remember that prices rotate. Prices very rarely go from A to B in a straight line. And even if it does, as gold did, go to your final target today, you may have to sit through a pretty hefty haircut. And that's not good for the mind. That's not good for your psychology. That's not good for if you're trying to hold trades. It's very difficult if you're holding size to sit through that. And if you're kind of developing as a trader, it makes life tough versus you're already locked in profit. You've already got a cushion. And so it's doing it in the upper portion of the trade. It's like, it doesn't matter. Like, well, I've already locked in this and I've got this here. It can do what it wants. I still think you can be much more relaxed. You can walk away versus, what it's like if you take a trade and it's kind of oscillating around your entry, you're up, you're down, you're up, you're down, you're up, you're down. There's nothing more frustrating and annoying and very walking away is tough then. Whereas if you've got plenty of cushion, it makes life easier. So all these things layer in and stack up to making your life easier, making it easier to execute, and hopefully making better trades from it. So price break, you're in late. This is the classic one, right? I'll buy if it breaks the level. So you buy, yeah, got confirmation, exactly what I want. It pulls back. You're in late, and maybe it dips below. It starts to put you under pressure. Maybe it's a full scale, a fake out, or it's just a natural rotation like today, and you're stuck, right? And actually, if you were in before that, and I'm not saying you can do it in every trade, but if you're in before that, you're now in a position where you can choose what to do. You're like, it's faked out. I'll peel some off. I'll put my stop at break even on the rest of it, and I'll see what happens. Maybe it's a little fake out, and I'll still believe in the trade. You get so much more power when you're in the trade before the proper move happens, so to speak. And you're planning your entry before that confirmation candle. You want, let's say, the wind behind you. You want to be in a position, reusing this phrase, but you want to be in a position of power. You want to be already in the trade when the confirmation, when everyone's talking about it. If you could monitor social media, say, like gold's breaking out, you want to be already positioned. You don't, at the very least, you don't want to be buying that situation. So a way to frame it, think about before you take the trade, context matters more than anything, and I kind of hopefully you get that regardless of where you're on your trading journey at the moment. You get that, you understand, hey, if we're in a rising tide, if we're in an uptrend, we need to kind of look for things that align with that. If we're in a quiet, choppy environment, waiting for data, it's a holiday coming up, then you're probably not going to get the breakout that you want. Is price behaving as expected? Is it holding bids? Is it starting to pick up volume in the right direction? Is it starting to have that kind of relentless held bid, not pulling back? If we go back, I don't want to overdo this one, but if you look back at kind of the drive from here, I mean, this is such a classic textbook type move off support, starts to hold, and you think about the kind of underlying trades going on, buyers just sitting there accumulating contracts, early in the morning, UK time, accumulating. They can't get any more done, so they start hitting offers, and that brings in more buyers, that brings in short coverers. Volume starts to pick up, a little bit more urgency, people a bit more time sensitive than price sensitive, and before you know it, you create that cascade up. So it's things like that to look for in the market you're trading. Where are we? Yeah, so is this price behaving as expected? How do you expect price to behave for the thesis you have? And where does the crowd come in? The crowd comes in when they break the high. And if we flip back a second to, if you're an intraday trader, let's say you trade something like NASDAQ, let's say you trade something like Dow, S&P, very often that market flushes through lows and then reverses. And so this is the same type of thing in that you don't want to wait for that low to break to get into the short. You want to be positioned in the short and closing into that flush, because the crowd is kind of just you're going to go falling through the floor. Nasdaq's going to die, and you're like, nah, hang on a second, I want to be positioned for this. And so if you take the trade with defined risk and you do these things, that becomes your version of confirmation. Now, if we go back to the mindset, back to Stevie Boy. Steve, I'm belittling you. Not Stevie Boy is a man. Steve Ward is the OG trading psychologist. You won't be 100% sure. Right? Your job is to act, thinking about the edge, not certainty. And we started this call with exactly that, because the confirmation comes from wanting certainty, and that never rewards traders. Again, that's incorrect. It can reward traders, but only when you're in a one-way street and things are kind of chugging on nicely. A good trader knows, hey, I'm going to be uncertain. Actually, the more uncertain I am, probably the better the trade, because I get paid more for it. I think even Buffett said this, and obviously he's not a trader, but like, if I take on a risk that others can't quantify, that's when I get the biggest reward. Now, I'm not saying you don't quantify your risk, but the point is you need, rather than waiting, you're there a little bit earlier. So think about this, right? If you have a 60% win rate in 3-1, that's a great place to be. If you can operate like that, that is fantastic. That will serve you and serve you and serve you and serve you, right? And that's when you go, okay, I'm not certain, but I know that here's my stop, here's my target, like the gold trade that was 3-1 just on the high. You say, well, I think we're going to break up the highs, but if I can at least get some off at the high there before the break, and I think it's about 60%. You just kind of put an arbitrary win rate on it. You think, well, the market we're in, the environment we're in, the driver, the catalyst, the prior day's move, the support that's held, I'd give that 60%, wouldn't you? And so all of a sudden, if you can do these trades more often, you have a much better place to be, as opposed to, hey, well, I'll take it here, I'll have my stop here. Do I put a 60% chance of it running back up to even higher, the 50s? Yeah, maybe not. But so you kind of want to still think of those levers you're pulling, the win rate, risk reward ratio, and saying, hey, listen, I don't want to be certain. I'm never going to be certain. I'm just know that if I stick to the process, as Steve was saying, rather than waiting for certainty, that's the way to do this. So something to consider, right? And if this has kind of resonated with you, there's some way to move forward here. You don't need confirmation from the market to act, right? You're a trader. You're an active trader. You don't need permission to take the trade, right? You decide when to deploy your hard-earned capital, right? You decide when to trade. And being someone who observes the market, understands price action, understands the flow of money, understands the rhythm and all the dynamic nature of the market, you know that actually there are going to be clues before the crowd has spotted it. And that should be your job. And I think that, listen, you trade as you like. I'm not here to tell another man how to trade. But I think if it's something that you find yourself very often late into a deal, you find yourself waiting for confirmation because you need that reassurance, try to unpick that and say to yourself, hey, I'm going to go one step back. I'm going to reverse engineer my thesis. Okay, that'll be confirmation. Okay, and that might be where you stop normally. Now go, well, what would be a precursor? What would be my new definition of confirmation? Well, if we started to find some support, we started to rally off there, we fade through a low, dip back up. Okay, that might now be your new trigger. So you need to plan a trigger where your risk is going to be, and that's it. And I think that's enough to really reframe the way you look at this. So one way to practice is to go through your old trades. TradingView's got a great replay feature, of course. And sort of note down the moment you thought about entry versus when you actually entered. And this, or why I say do this, right, is that when you don't have the burden of performance on your shoulders, so you go into the trading day like, I need to make some trades, I need to make trade. You're looking at price through a different lens. When you go back and you conduct a replay, whether you use TradingView or some other tool out there, and by the way, if you're a Pepperstone client, they are offering, I believe, is still offering 3 months of TradingView. I think not 3 months. You can get TradingView for free, and obviously, if you want to become a new client, they give you for free as well. So it's worth contacting them and saying, "Hey, can I have that? See if that offer's still available." I digress. But the point is that if you're replaying, you have a different lens you're looking at stuff through, right? And so you can now go and say, "Hey, I want to see if there's any indication that this price is moving before the crowd spots it. And if you look at it with that intention, you will see stuff. I know you will. I know if you replay things and you go, hang on a second, look at that damn bar, right? That might only be a 5-minute bar or 2 5-minute bars, but they stood out. There was aggression, and the precursor was support held. And now I've seen momentum ignition on the lower time frame that I wasn't looking for because I was waiting for that down 60-minute bar to close. Right. Now that may become your definition of confirmation. You jot that down. You say, hey, if I see support hold, 2 ignition bars, that's my confirmation now. The suckers can wait for the close. I'm going to get in there and I'm going to be in position of power. And so it's a really good exercise to do. It doesn't take long, going through the trades, going through just observing and saying, have I missed anything? Have I missed anything? Have I missed anything? And like I say, don't have to go down the lower time frames to do it. I think it helps. But if you find that going down the lower time frames encourages over trading, then obviously don't do it. But you still see tape holding. You still see price going 54, 5, 6, 7, 8, 9, 60, 59, 59, 59, 59, 61, 2, 3. You can see that on a 15-minute chart, 5-minute chart, 1-minute chart, right? It's the price is the price. And so, obviously that's going to depend on the replay speed you use. But, could you have acted earlier with a smaller stop? And I hope you understand that I'm not saying we de-risk things by having a tight stop. That's dangerous as hell. Actually, I think it's more risk. It's, what's the new definition of confirmation that I can now look for that allows me to structure trades with a high probability of success and a high risk reward ratio. And that's all you're trying to do as a trader, and letting the process play out and saying, if that's 60-40, 3-1, I know that wins. But it's probably more. You can get more than that with enough practice, right? So recap: confirmation, I think, is lagging. Look for price intent, not those textbook patterns. Define confirmation on your terms. Try and redefine what you think is confirmation. Take the textbook and bin it. Act earlier, again with all the caution, the risk kind of caveats that come with this. Smaller size if you need to, because you're looking for, maybe you're actually looking for potentially bigger trades in terms of RVR. So actually, if you struggle, and this is the kind of conundrum I think a lot of traders go through. They go, well, if I'm 2-1, is it worth my while sitting here if I'm making a couple $100 here and I'm losing $100 here? It's like, at the end of the week, you kind of go, what's the point? And so you start to size up because you think you want, and sometimes that's not the way to do it. Sometimes the way to go is, well, if I get in earlier, I can now get 4-1, 5-1 instead of 2-1. Is it always going to work? No. But even if the ones it doesn't, if it works out in the wash, all of a sudden, if I'm risking $100, $1,000, $2,000, now when that works out in the wash, that becomes worth my while, and I don't actually necessarily have to scale things up. I can just look to be a little bit earlier and kind of focus my attention on looking for an earlier confirmation, and I can have more conviction. So some things, action steps you might choose to take: review those 3 recent setups that you perhaps missed or that you were waiting for confirmation, or even just trades that you took and maybe a bit late. You took a lot of adverse excursion on the deals. Define maybe something for you, like a minimum evidence or a new confirmation for you to pull the trigger, and start to build trust, in earlier entries. And now, okay, might not be for everybody, and I always say this at webinars, it's like everyone's very, very different. Everyone approaches the market in a different way. But I think if it resonates with you and you're like, hang on a second, that doesn't make sense, it's worth exploring, because it's something a lot of people miss. And they go, well, I should hold my trade longer. I need to size up. And that's the classic fixes, if you like, for doing better. But actually, maybe buying on red, or as in, when I say buying on red, I mean, if you think of, I think of the market as a sine wave rotating, buying on the kind of red rotation lower as opposed to buying on the green. Just that little shift alone can double the win rate, or double the kind of profit potential that you make on the trade versus the ones you don't. So something to consider. Let's take some questions, ladies and gents. Phew. Okay. So I will have a look at the questions. I hope that's been some value. If you want to check out, obviously, Pepperstone, thank you for allowing me to talk about what I like to talk about with trading. And if you want to check out my website, there's loads of other free content and goodies on there, tradesmastermind.com. Discipline tracker, 30,000 people have downloaded that now. That's a Google sheet to help you really build the habits you want to with trading, and you kind of just duplicate the tabs, you tick it off as you go. Many of you have got that already, but yeah, we're 30,000 downloads now. So go and grab that if you like. Okay. Grant says, let me bring you guys over here. Okay. By the way, next week we have the terrain target trigger framework. So this is something that I've kind of quite new for me to approach. Well, nothing's new. Wyckoff and let him Jesse Livermore been doing this way for us, boys. But it is it's a framework that I like to look at now, like this terrain trigger target or target trigger framework. We're going to discuss more on that next week. Okay, Grant says is chasing generally a worse habit than being too late. Do you know what, Grant? Here's my take on things, and I write it down every day, right here on my pad. Buy on red, sell on green, and I don't mean stepping in front of a freight train. But what I mean is that's a general lens to look at my trading through, and I think that's good for a lot of traders as well. Is that you want price to come to you. So even if you're buying an uptrend and you're buying momentum, you want to be price pulling back. You want to generally, I'm generalizing, but you want to be in that position so that you're in a position of power and you're in a position of control when price goes in your favor. So to answer your question, I think there are setups, of course, when you want to just be hitting bids, you want to just be buying highs because there's aggressive momentum and you put your stop in and you're riding momentum wave. But they're few and far between. And I think that generally speaking, the rush of that, the emotional impact of that is negative on when you kind of net it all out, and it's far better to kind of wait and be patient and kind of hold bids as you go up, or wait for pullbacks, or wait for rotations, even if it's different dynamics and stuff. So I think chasing is a very, very bad habit, and you kind of wrap it up in your mind as saying, well, I'm buying momentum. I'm not chasing, I'm buying momentum. But I think if you worked out all the trades you took where you were buying those fresh highs, they probably wouldn't serve you as much. And also, listen, don't forget, Grant and everybody, we're all the same, right? We buy those highs and we chase the market and we feel like it's an easy trade, and the market goes up a little bit and it starts to stall. What do you think? You start to think, sugar, could easily rotate back here and it will still be an uptrend. And I've bought the blooming high tick. So you come out of the trade quick. And so it's harder to hold a trade when you kind of feel like you're at the end, you feel like you're kind of towards the end of the move. David says, what did Dave say? So I've been following you for a long time. Thank you, David. So I use the 15-minute for setup and level and 1 minute to front run the trade. I also follow Axia futures. I've never used a price ladder, but I've translated it as my 1 minute is equivalent of ladder in my trading, 1 minute order flow. David, I think that's exactly the right approach. The tape is something that if you do go down the rabbit hole, fine. But I think you can get most of the information you need on the 1 minute time frame, because you're watching in a day the bids and the offers that you see on the order book. If you kind of look at direct market access, it's noisy. There's a lot going on, right? Versus if you're just watching price move, like Jesse Livermore used to do, that's tape reading and how it responds. Does it lift up, hold? Does it pull back, hold? How does it respond to a level? That's more than enough. You don't need to kind of open the door of, I don't think so, some die-hard dome guys. And I was a die-hard dome guy. Yeah, that was my edge for many, many years. But I think the game's changed. The markets are way higher than they were. Volatility's gone crazy. So unless it's something you're carrying on from those years, I think you're doing exactly the right thing by reading tape, as in watching the price movement and price change, just like you're doing on that lower time frame chart. You can get so much information, how it responds to key levels, prior lows, prior highs, how it responds after ignition. Like the gold explosion, most times it's going to fade back, right? It's a mean markets generally mean reverting. They leave a liquidity vacuum as price kind of lifts offers. It kind of rotates back. But when those bids are stacking up, you're like, hang on a second, it's gone 15, 16, 17, 18, 19, 20, 21, 20, 20, 19, 20, 21. It's like that should come back to 16. That's strong. Okay, I need to kind of look to get on that. In long gold was picture perfect gold. David says, good for you, David. Right. I should really check that. Okay, so another question for David. Say you struggle to catch the low. How do you finesse the entry after the breakout? Do you know what? If you buy in the breakout, I don't see anything wrong with buying a breakout, right? But I find it puts you in such a weak position, because how many times does the price break out and then come back and you're like, well, yeah, that's normal, but how much room do I give it? And so unless you're looking for real big extension, I always want to be in the breakout, or I want to wait for the break and a flag and kind of trade off that. But again, that's a personal thing. You know, I just think that it ruins the structure of the trade most of the time if you're waiting for, that true breakout, if you like, and waiting to do the textbook type of stuff. Anthony says, "Hi, great webinar." Thank you, Anthony. Appreciate that. I've been part of the last 7, 8 webinars and I'm making some great notes. Would love the recordings. Would that be possible? Yeah, this should be sent to you, Anthony. And actually, if you go onto the Pepperstone YouTube channel, um, I think under playlists, if you go there under playlists, you may find them. I don't know how late they are going on, but there's a kind of a delay because I want to keep them for people who register for the webinar, and then eventually they will go up on YouTube. But you should get a copy. If you don't, send me an email. I'll sort you out, or my assistant Armand will. Bob, I think I agree with most things here. Okay, Bob, I like the start. Most things, all right. When you go down to lower time frame on the gold example with the 15 and 5-minute chart, the 5-minute breakout was the best entry. So I guess depending on how you frame it, breakouts work really well to frame the entry on the lower time frame. Yes, Bob, you're right, absolutely. And if you were looking at, if your thesis was, I think there's a 5-minute breakout, then that's fine. But it's kind of, if you're saying, hey, I'm waiting for the breakout of that prior high, and you kind of then go down the time frame and you use that to leverage yourself into that higher time frame move. I think that's where the kind of the additional edges, if you like. Okay. I appreciate that question, Bob. Right. Gary says, great topic. Enjoyed this. Thank you, sir. Alison says, thanks, Mark. This is excellent. Something I've been battling with lately. Much appreciated. Joe, good. You know what, Alison? We've all been there, and I think and I'm not saying okay, this is some sort of silver bullet and panacea of trading, but I think the big unlock for many traders is really going, hang on a second, how do I do things my way? How do I keep the risk managed? How am I smart in terms of how I enter the trade? How do I stack the odds in my favor? How do I even make a 50-50 bet, if you like, but actually, if I'm right, then I really get paid out. And sometimes it's not about trading size. Sometimes it's not about, doing, the textbook thing. Sometimes it's doing things your way. And the best traders do things their way. Yeah, they're managing risk and doing stuff, but it's just sometimes that's a really big unlock. Okay, Bob says the character shift kind of was a breakout. Yeah. If you're looking at 5, you're absolutely right, Bob. Ruben says, was in a very similar situation today, trading Euro USD breakout. Okay, Ruben. I was waiting for a 15-minute bullish candle to close above 1.17. I got faked out due to 3-bar rejections of the price level, only for price to break out in traditional fashion. Really glad you covered this, mate. Ruben from Pepperstone Talks a couple of years ago, we talked about AI during the breakout. Ruben, I remember you. Pepperstone Talks, we did a talk in London. Another big factor in faking myself out. Don't listen to YouTube trader gurus whilst you're trading intraday. I couldn't possibly comment, but I think you're right. You know what? I think you're better to listen to nobody during the trading day, especially not the trader gurus. Everyone's in front of a Lambo. Be careful. Right. Junaid says, thanks for the webinar. Great advice. Thank you, sir. Run through these quickly. Susan says, thank you for the great presentation. It resonates with me. Love to get in where the masses would put their stops. Yes, good thinking. Susan, do you know what, Susan? This is what the locals would do years ago. I used to listen to the pit audio, the S&P 500 audio pit in Chicago, and it would be fed to me, via an audio feed. I'd subscribe to this. There was a guy who used to kind of tell you what was going on in the pit, and you'd also hear the kind of roar of the pit. And this is when we kind of would transition to electronic. The pit was still going, and the locals, the guys who were trading back and forth, making trying to make a margin from that, they would force the market through lows or through highs. And there was one guy, number one local, Luis Borsellino, his name was. He would push the market. He'd know when everyone was trapped, and he'd know where liquidity was, and he would shove the market when he could do this. And there's some nuances to this, but he'd shove it in one direction, and he'd wait for everyone to be on the other side of it, and he'd come out into those traders. And I actually messaged him on LinkedIn a while ago, and I said, "Listen, pal, I used to, don't know me, blah blah blah." used to listen to you years ago in the pit audio. This was my take on your strategy. Tell me if I'm right. And I said you would kind of wait until a quiet day. You would then you would offer below the bid, force out the smaller locals, knew there would be a liquidation under the low, and you cover into that. And he would do that, and he replied and went, "Yeah, you're right, but I do it both sides." So the point is that yeah, you kind of have to think one step ahead of the crowd, and that's not always going against the crowd. Don't get me wrong, but it's you either want to be with the crowd so you're early, and the crowd rising helps you with your trade, or you kind of want that max euphoria or max exhaustion kind of move. In the gold futures you're displaying, would you be targeting the immediate swing high, or will you trail the trade in anticipation of breakout and follow to the next high? So, Eric, if that was your thesis, right? And I'm not, I know you got to be careful, you're not hindsight trading here. I'm not a hindsight trader, right? But if your thesis was a breakout of that prior day's high, which I think, regardless of what you trade, that's a decent enough thesis. It did actually work out. Let's assume we didn't know that. Let's assume, which we have to do when we're analyzing stuff with the benefit of hindsight. Let's assume that we had the thesis that we're going to break out. The idea then is, rather than buying the breakout, you're front running the trade, but then you're in a position of power where you can either, what I call, cash flow the trade as it approaches that break if you wanted to, or you hold and trail, as you quite rightly suggest, because your thesis is still that you're going to break. Now, people might say to me, "Oh, well, why would you cash flow the trade?" Well, maybe you wouldn't, but sometimes that just soothes that desire to hold it all in, all out. You can kind of pay yourself for that early, for being early, and then hold a chunk for the bigger move if you need to. What is this? Can we enter on a retest of our POI? You can enter on a retest if you listen. However you frame this, you can adjust it as you see fit. But the point is, you're being smart. You're not getting caught up in the crowd. You're saying, what's the crowd going to do? Why would I want to be positioned for this? How's the crowd going to help me? How's it not going to help me? Anthony Vallone, good to see you, pal. How do you view getting in on a pullback or area of interest versus this approach? I think that's just as valid, Anthony, and that's a separate trade. And I think that's something you do. It's a separate playbook, and it works very, very well. You wait for it to pull back, but you're buying the pullback in anticipation that there's going to be a momentum breakout. So it's a similar type of thing, right? But you're just kind of wrapping it slightly differently. And I would dare to say, Anthony, that you like to see the price kind of shudder lower, rip straight back up. That's your buy in the context, and you're now looking for a further higher target. But that confirmation for you is the pullback, the little exhaustion, the bid that pops straight back up. That's your confirmation. You buy that, stop goes below the low. Same structure. Maybe it's not as kind of broad as the gold example, but you're doing the kind of same type of thing. Okay. I think we've covered. Oh no, there's a few more here. This could be better interface. There's two more. I do believe this is the closest to Holy Grail in trading. I think it is the silver bullet. Gotta be honest. I'm not sure it's a silver bullet, David, but hopefully, if you curb the overtrading and it going down to enter is perfect. The overtrading is a big one. You know what? Very often, you know what? You can wait for the best trade, but if you end up just giving back all the profits because you're punting away on little movements, that's the first thing to eliminate. Then worry about getting really good at kind of trying to fine tune these entries. Final thing here. Thanks, Mark. Advice from one of your Pepperstone sessions a few weeks ago to my sister Falabella got me funded. Oh, good for you. That's your sister, was it? Good for you. Well, I'm glad that this is helping you guys. That's my objective when I come on here. That's my hope. And so hopefully today has been no different, and you take a few things away that help you with your trading wherever you may be in your journey. First couple of years, maybe a decade in, whatever it might be, hopefully take something away and can put it to work and just trade better. So we'll call it evening there. Thank you so much. Same time next week. Good to see you. Thank you for coming on. I do appreciate you. Thank you, guys. Bye-bye.